I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is August 3rd.
And today we'll be talking about mortgage rates and the 10-year yield. Where are they? What's the update? Also, Fitch. Fitch came out with a really important agency downgrade on the U.S. credit rating. What does that mean?
Yeah, who is Fitch?
Who's Fitch? That's someone's uncle? No, it's one of the big three reporting agencies or credit reporting agencies.
And if remember, this is for informational purposes only. This is not financial advice. And if you like what we're doing here, be sure to subscribe, comment, and like. Tom and I are mortgage brokers right here in Phoenix, Arizona. We are licensed only in the state of Arizona. We can help out customers who are looking to refinance or purchase. So if you have a scenario, be sure to call us, comment, or email us anytime. Okay, so let's get right into the interest rate update today. Mortgage rates for the 30-year fix, we see at 7.13% according to the Mortgage News Daily, and the 15-year fix we see at 6.48.
The 30-year FHA 6.78 and the 30-year VA 6.82. A little bit different. Usually they're the exact same. But
yes, and this is the survey taking from a national point of view what mortgage quotes have been. And again, we're mortgage brokers. Our quotes are going to be different. We do have better rates than the national average. So be sure to contact us if you have any questions on your scenario. All right. So the 10-year yield, which drives a lot of different markets, but particularly the 30-year fixed mortgage. Whatever the 10-year yield does, or the 10-year does, that's what mortgages will do. More than the 30-year fix, the 15-year, any mortgage-related product. And this is the chart going all the way back to the fall of 2022, so almost a year. But the mortgage rates, or the 10-year yield hit a high, and so did mortgages right about October 20th. I think that was, about October 20th, 2022.
okay.
They came down in 2023 towards the first of the year, and then came back up March 2nd. Okay, and then they came down, and we are right back where we were on March 2nd. We've busted through this channel, and we're now right at that high. And I drew these, we have these two green lines here for a channel going down. We busted up at the end of June, and we're now back at this line, which we call a resistance line.
Yeah, it's like Empire Strikes Back, talk about these resistance lines.
Yeah.
Like, what does this mean? We were trying to go after a channel by which we thought these interest rates were going to stay within. But, like most things in life, they don't have to stay in your channels, or they don't have to stay within your projections.
Yeah, we were hoping they would stay within these green lines, and it did bust out towards the end of June. And now we've been bounced off of this March 2nd high, came down, and then we're back up to it. And right now is a really a point where it's either going to break up or fall down. Yeah.
And so how does the layman actually interpret like this information? What are you supposed to do with it? All we're basically telling you is that there's patterns. These patterns, have basically, gone above what we thought they would be doing. And obviously for good reason. There are things happening in the marketplace, whether the inflation's too sticky or stickier than they thought, or the feds, or the credit reporting agencies, decide to change some of the credit ratings on the U.S. government bond, or for whatever reason, it's just simply not doing what we thought it was going to do.
Yes.
What some of the experts were saying.
And it's the reason is the information in the economy has still been too good. Inflation is still not low enough. The employment is still strong. The companies are still showing profits. People are still buying stuff. So the economy are still showing strong numbers. Even though inflation is coming down, it's not coming down fast enough.
Yeah, and it's very odd. I mean, when's the last time we said, bad news is good news? We're still in a bad news is good news environment, and I cannot wait till we can get out of that.
Yes.
We need to be in an environment where good news is good news. I mean, the world's already crazy enough.
And so speaking the good segues, here's bad news. August 1st, Fitch, which is one of the credit agencies, downgrades the U.S. long-term rating to a AA+. Now, that is that's a negative thing. We were at a AAA rating, and they've reduced it down to AA+. But really, a lot of you are probably asking, what does that have to do with anything? What is Fitch?
Well, yeah, and also, but before we actually, tell you what that means. In that it's a little bit not funny, but it goes from AAA to AA plus. I mean, that sounds like the difference between. You know,
it's like at school, like you're getting, these are pretty nice teachers. These are teachers that give you an A plus, and then they give you an A.
I mean, yeah,
like
no,
mine is like maybe it's like an A plus.
Well, how about that? Instead
plus.
Instead of having 100% in your paper, your teacher gave you 99.9994.
Yeah,
it's still amazing credit rating. So I just want to get that out. This is AA plus. Yeah. But the point is, it did move. The needle moved.
Yes,
and that's important.
Yeah, in one way, they don't want to scare people or think that things are falling apart, but that it is a reduction in the confidence. So Fitch is one of the three big credit agencies. There's three of them: Fitch, Moody's, and S&P Global. They are the ones who come out and give their recommendations, or they provide investors with information. This is, what's the purpose of these agencies? They're like the teachers. They grade the papers, they grade the work, and they each do it.
Yeah, you don't want to ask the student, what he got on their test. Hey, what'd you get on your test? Oh, I got 100.
They're three judges. That's what there are.
Yeah.
It's like three judges judging the performance of the debt, and whether or not our country, the U.S., can be paying back its obligations, its debt obligations.
And they do, checks on all different types of corporations. So the country is not too big for a credit check, which is actually kind of nice to know that. I mean, again, the federal government operates like a business. It has to. So agencies provide this information about the country's sovereign debt, and that's what they just did the Fitch came out on August 1st. Again, Moody's and Standard & Poor's have not done anything. We may hear something from them, but at least this information that we hear is at least, again, it's that bad news is good, is that interest rates and how they affect, of course, residential mortgages, commercial mortgages, this is good news. In a way, like this is good news because it's not great news.
That the Fed will likely start moving its Fed rate lower, and hopefully sooner, and we'll have some relief on the interest rates. Interest rates cannot continue to go up. Things are going to break, and we start seeing this right now. And of course, the debt of the U.S., the interest payments are calculated using the interest rates, the prime rate, and so higher the interest rates are for the U.S. government, the harder it is for them to make.
Yeah, harder for them to keep paying.
Okay, so good news, bad news. Okay,
well, in this case, it's bad news was good news.
That's right.
Okay,
so if you like what we're doing here, be sure to subscribe, comment, and like. Tom and I will be back next week. Again, if you have any mortgage questions or scenarios you want to run by us, be sure to comment, email, or call us.
All right. Hey, thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.